Hello and welcome. My name is Paul Wallace. I'm a capital markets writer at The Banker magazine, and I'm here with Tim Skeet, who's a managing director at RBS and a board member of ICMA, the International Capital Markets Association. 50 years ago this week, Autostrada, an Italian motorway operator, issued a $15 million bond. It was the first so-called Eurobond, which was issued to capture some of the US dollars swashing around in Europe at the time. From those humble beginnings, the market has become one of the biggest and most important in global finance. Last year, just under $4 trillion of securities were issued. Tim, thanks for joining us. Firstly, what was it that brought about the creation of the Eurobond market in 1963, and how did it become so big?
Well, one of the fascinating things about the origins of this market was it came about really as a result of regulatory change, particularly in the United States, to do with the tax treatment. A lot of the offshore dollars that had built up in the pockets of the US corporates, which had been investing heavily in Europe and earning money. So we had all of a sudden a pool of trapped dollars offshore. And then there were some regulatory changes also in Switzerland, which actually then brought the market to London effectively. So it was regulatory change, it was tax change that was actually the spark that allowed this market to be created. And remember that Eurobonds were at that time bearer instruments, and the coupons were paid gross of any tax, so no withholding tax. And that was the key to the origins of this market, and that's what sustained it certainly for the early years of its extremely rapid and very exciting growth. But it pays to remember that regulatory change often has interesting and unintended consequences, of which of course we here in Europe and in London in particular have been beneficiaries.
Apart from its size, how is the market different today from how it was in the 1960s?
Well, the technology is the obvious first thing, and the speed of execution. Back then, if you opened the books on a transaction, you'd leave them open for some period of time before people managed to rustle up the demand for a transaction. Now, of course, you open and close the books on a multi-billion transaction in a matter of an hour or so. The documentation, likewise. Autostrada, if you look at the prospectus, it's a few pages. Now, a prospectus for any deal runs into hundreds of pages with caveats and warnings and a host of other things. And of course, we have the prospectus directive here under EU law, which of course has added further pages to these documents. So you've got a lot more legal and documentation and listing requirements. You've got a lot more paperwork in the background, the speeds of execution, the technology, of course, in those days, I think the point has been made, settlement was a very primitive affair. People might wait years before they got their bonds delivered. Now, of course, we've got T+2, so the whole process of getting a transaction from zero to somewhere, creation and delivery of the bonds is extremely rapid.
It's much quicker.
And settlement and the money, of course, flows through much, much quicker. So all sorts of very rapid change.
The creation of the euro was obviously a seminal moment for the continent, but what impact did that have on the Eurobond market?
Well, of course, that's helped it immensely. What you did have prior to the euro were a whole load of individual regional markets. Now, we haven't moved completely away from the nature of individual markets because there are individual pockets of demand. But of course, with the euro, you have one big pool of liquidity into which people can tap, almost rivaling the US dollar. Now, we know that we've just been through a period when we've seen the future of the euro look a little bit uncertain, but you know, being the optimist that I am, I think we can look with some confidence that the euro is likely to survive and actually emerge a stronger currency. Let's hope it does. And certainly what we've seen is the regional nature of the market has now become more centralized. We've gone to a completely new style of market. And that's, of course, very exciting. It's very good for governments that are raising large amounts of money, because now we have a considerable pool of all forms of institutional demand in Europe, which is very, very significant and deep for all types of borrowers.
Do you think it's fair to say that the Eurobond market played any part in the 2007-2008 credit crunch and banking crisis, or do you think that's an unfair assessment?
Well, I think the Eurobond market in many ways was collateral damage. A lot of things flow through the Eurobond market, but what's really quite interesting is the original epicenter of this was in the United States. So the worst of the real pain was suffered through the US capital market and of course the structured finance side in the US. Now it's true that there was some structured finance in Europe, but at the periphery which suffered. What we also saw in Europe, of course, was this very significant government debt market. Now, interestingly enough, part of the problem there, and if we talk about the Greek situation, is a lot of the Greek debt was not, in fact, Eurobond. It was domestic debt. And of course, then you get into the semantics.
So it was a different type
domestic.
of instrument.
It was under Greek law, and it was not documented in the way that Eurobonds are documented. Remember, we at the ICMA, at ICMA, we have certain standards of documentation and delivery and all sorts of things, investor protection rules, which are simply not there for the domestic issuance prior to now. So what we were looking at during the crisis was collateral damage across a lot of the markets as a result of the instability, as a result of the things that were happening, first of all to the sovereigns, then to the banking system. But in fact, if we look at the Eurobond market, with the intervention from the central banks have used the market by pumping liquidity into it or withdrawing liquidity through supporting different sectors. The support they gave to the covered bond sector, a €2 trillion market. It's been one of the instruments of policy, I would say, and it actually fared very well.
What do you think the future holds for the Eurobond market, and do you think that London will remain its main hub?
Well, I think the Eurobond market is a market which is very vibrant. It's constantly moving and changing and updating. Yes, the regulations are heavier now than they have been. We've had a lot of talk about the financial transactions tax and various other things which could significantly change the nature of this market. Now, as things happen, I think reason is will prevail, and we will see a market evolve which will become a disintermediated market to a large extent. At the moment, we've got this originate, underwrite, distribute model using extensively the banks. We will get to a point where the originate part will be there, but the distribution and some of the subsequent trading may be more direct or electronic or through the investors directly. I mean, we've got all sorts of exciting things happening through the implementation of technology, through the central clearing systems. I think we have to anticipate change. And what we are also seeing, of course, is a little bit as we've seen in the United States, where the predominantly corporates can go straight to the bond market. That's something we're likely to see increasingly in Europe as well. So we've got all sorts of developments which I think we're anticipating now. We're adapting our business models to adapt. And I think we've got a bright future for the market generally. It's a pool of liquidity which is not going away. And we've seen the Eurobond market, it started in dollars, it's expanded into euros. We see the dollar component is still significant. We've got all of the Asian markets are effectively become part of the Eurobond market as such. The second question you asked, of course, is the future of London.
Of London.
And of course, you know, I have to say I am a local. I'm a Londoner myself. So as a lifelong practitioner in this market, it is my hope as a local that the market stays in what has become its home and has been the home for the past 50 years. I think to some extent that will be down to regulation. It will be down to the political will. But I hope and I believe that London will go on remaining a centre. And why? Because we have the expertise, we have the teams of lawyers, we have the banks here, we have a lot of the secondary market, we have an enormous amount of innovation here and brain power that's going into keeping the wheels turning in this market, and it's not a market that's static. So I believe that this will still be the epicenter for the Euro market. But let's not forget, there are regional sectors still, there are regional pools of expertise, of liquidity and investors. And I think that's the nature of our market, is it all embracing. It's not just about London. But London, I hope, will still stand as the primus inter pares.
Tim, thank you very much.
Thank you very much indeed, Paul.